Professor, I want to start with how hawkish or dovish was Jay Powell in his presser? There's a lot being made of the fact that, and the very first question he was asked, among other things, if the Fed could do rate hikes at every meeting. He talked a lot about the uncertainty in inflation. He didn't say it could, nor did he say it couldn't, and people are interpreting that as, aha, he didn't say that they wouldn't do that, so it's still on the table. What do you think, especially as a former central banker yourself?
Well, you never want to limit your flexibility, right? So I think he did the right thing, which is not really comment on that issue. Now, that doesn't mean he will do it, but he wants to retain the ability to raise interest rates at every meeting, or perhaps even do a 50 basis point raise at some meeting. I think his tone in general was more hawkish than the statement itself, but that was because he was filling in some of the blanks that the statement had. We will raise rates, it will be appropriate to raise the target range. That's what the statement said. And he basically said March. So I think he filled in the blanks. That was seen as much more hawkish. But, I think he did a reasonable thing there.
Given where inflation is now, given where the economy is now, he was fairly positive on the labor market, for example. How many rate hikes will the Fed need to do, or more broadly, just how aggressive are they going to need to be this year?
So I think that when you look at bond yields, the 10-year at 1.87, the five-year forward expectations of inflation below 2, there is the sense that the Fed will have it under control, but without having to raise rates too much. And that's where I think there's a little bit of a disconnect. That certainly implies that certain elements of inflation today are transitory. The Fed won't have to do too much to bring it back under control. But, usually, if inflation is expected to be 2.5, 3 over the foreseeable future, the Fed has to raise rates a significant amount above that to bring it down. So something like 3.5, 4. And that's simply not being priced in right now. And my sense is maybe that's where the market will have to go to actually realize fully what the Fed has to do.
Recently we spoke on a panel, and you talked a lot about emerging markets. What is the message for emerging markets? Is this priced in for them, too, that this is a Fed that is serious? This is a central bank that means to do whatever it takes, apparently, that's how I interpret it, to make sure inflation stops rising and starts coming back towards that 2% target?
I think that was the message that Chairman Powell was trying to convey, that we will do whatever it takes. He did, however, say this is a world with a lot of uncertainty. And obviously, when you look at the uncertainties around the world, I mean, there is, of course, the China issue. How strong will Chinese growth be? How much will the property sector matter? How much will the Chinese lockdowns matter going forward? And of course, there's the very big Russia-Ukraine issue. Will Russia make a move? Will oil prices go through the roof? Will that tank growth? I mean, these are, I think, very big uncertainties. And of course, the virus is still can't be sort of written off. So I think he said we will be taking that into account. But on current trends, we have a strong labor market, we have reasonable growth, and it's time for us to raise rates. And don't believe that we will not work our hardest to bring inflation under control and essentially set the grounds for stronger growth over the medium term.
Has the Federal Reserve fallen behind, especially compared to other central banks like Chile, for example, today raising 150 basis points, even Brazil having the world's most aggressive tightening policy, and even their inflation numbers are not really being tamed and not falling below those double-digit gains. So I'm thinking, even if the Fed starts acting now compared to everybody else, when will they potentially be able to really rein in prices?
Well, I think the sense is recent inflation numbers, as well as the strength of the labor market, has surprised the Fed somewhat. Recall that they were saying transitory till some time back, and until Chairman Powell at the last meeting retired the term. So my guess is, yes, it is possible the Fed has fallen a little behind, But the Fed, to some extent, is a prisoner of the new framework it has. It had to wait till it was more certain that inflation was really fairly strong. And moreover, Fed actions have multiplicatory effects across the world. So it's not just about the US, it's about the rest of the world also. The Fed is somewhat cautious about changing tack. It has changed tack. I think from being in wait and see mode till a few months ago to actually being aggressive as of today.
One of the things that really sent markets falling and yields spiking was when Jay Powell said he was confident the Fed can raise rates without threatening the labour market. Was he correct in that? Do markets share that view?
Again, the markets aren't building in the normal sort of Fed reaction to this kind of inflation. And that could mean one of a number of things. Maybe growth falls off a cliff as the Fed raises interest rates. I doubt that, but that's one possibility. The other is financial markets fall, and then the Fed sort of has to back off because the wealth effects, the loss of confidence, all that essentially causes activity to slow. At this point, I don't think the Fed sort of believes either of these two is a huge risk and wants to act appropriately. But I think this is one of the reasons we are in a new world. The Fed is giving itself some room to react if necessary.
Quickly, I want to ask you one last question on China versus Fed. PBOC, China has a property market that's falling apart. You mentioned that. Fed's fighting inflation, different directions. What does that mean for China?
Well, for China itself, I think obviously the PBOC is more important, but it's also important there be strong export demand, from the rest of the world for Chinese goods. And I think that at this point, the extent of Fed actions that are predicted right now and the pace of Fed actions will not take that off the table. There will be still strong demand for China. The bigger issue for China, I think, is can it meet that demand with some of the ways it's dealing with COVID, with these lockdowns, with potential effects on supply chains and so on. That's the big question at this point.